look, I mean, I'm just going to get on my soapbox. This is a probabilities business. And if you're going to sit there and say, well, this layoff announcement data is volatile from month to month, and it's not a perfect guide for unemployment. Okay, fine. But tell me why the unemployment rate's going down. Tell me why employment growth is likely to speed up. Tell me why we shouldn't worry about the fact that it's not, I mean, this is what's interesting about the layoffs now is that this is not DOGE related. This has to do with, this is across different industries. It's across, it's across the country. I mean, it's more widespread than it was 6 to 8 months ago. And that's what the hawks, in my opinion, miss.
RenMac Off Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice because it's not. Here we go.
All right, welcome to RenMac Off Script, where we openly discuss markets, economics, policy, history, and life. It is the first Friday of November 2025, the 7th, and the second straight month with no payroll report. I'm Steve Duttenhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
So I almost don't even want to start with the payroll or the shutdown. I mean, are we ever going to get people back to work? Are we ever going to get prices down? It's just blah, blah, blah. So angry. Just want to be done with it already.
Steve made a great point this morning in the morning call, I thought, which is, I mean, it's really sad if this is true, but I have an inclination that it probably is more true than not, that the government shutdown will end before Congress has to go back to their districts because they don't want the travel snafus. That is so petty, and I really hope that that's not the case, but I can see how that might actually happen.
Yeah, it sounds silly, but Congress isn't known at this point for attracting serious people, so I think there's some merit to that.
Yeah. Hey, I did hear that Nancy Pelosi is retiring, but she's been courted by several hedge funds to come work in her retirement.
I can confirm the former, but not the latter.
We won't name names.
Classic moderator says he doesn't want to start with that, and we end up starting with that. Jeff, let's start with the markets. You had a nice piece out on Tuesday, your weekly survival guide, and then again on Wednesday, expanding on it, just about sort of 52-week highs and 52-week lows and what that means for the market. Apparently, it's the first real mismatch you've seen now in the breadth discussion.
Yeah, we've dunked on breadth for probably a couple years now, as kind of a sour grapes issue, but. One of the things, and again, a lot of that has to do with relative performance, but one of the things that we do on the weekends is we aggregate a bunch of data. And what we noticed in our high-low work, so 52-week highs, just what percentage of names are making 52-week highs, what percentage of names are making 52-week lows. That number was actually very close this last week. It was about 12% for 52-week lows. And it was about 14% for 52-week highs. Neither one of those numbers, in isolation is astounding, but the fact that both of them are relatively elevated is actually pretty interesting. And, you go back and look, and that's the kind of breadth that you start to see divergences. In other words, you have a handful of names that are actually going down and making 52-week lows. At the same time, you've got a handful of names that are making 52-week highs. Usually it's lopsided, right? It's, 25% of the market's making 52-week highs, and there's 1 or less percent making 52-week lows. So you get that elevation, and that's exactly what we look for in terms of some of those breadth divergences. And I think there are, and we mentioned this maybe 2 months ago when I got back from vacation and went through a bunch of charts. And I was really shocked at how many kind of short ideas were out there, and that continues to percolate. Restaurants, building products, home builders made a new relative strength low, but you're seeing some areas of the market that software, as an example, that look vulnerable. So the good news is that presents a lot of opportunities to have a balanced book, to run kind of a neutral book and still be able to make money on both the shorts and the longs. And then the real question is what does that imply for the market? Is that a market top? Now, these things did happen. And so we look at that within, call it 5% of an all-time high. These things happened in 2016 before that big consolidation. It actually happened regrettably in 2008, very close to the peak, and it did happen in 2000 during the dot-com bubble. Now, plenty of other times where the market just kind of paused and it moved forward, but there are some doozies in there that stand out. So we've got to keep our wits about us and watch this. And as we have always done this in this business, is we are what I call incrementalists, right? We're not going to come out and just be, we're bearish. I mean, that just doesn't work. And I know that makes a lot of headlines and people, kind of love that, but that's not a great way to run money. Incrementally, you just look for that deterioration and you press on that when you see that deterioration. So certainly, our book, as we're looking at it right now, is much more balanced in terms of long, short. And I think that's a real message from those 52-week highs and lows, which are both elevated.
And as just to add on to that, you talk about sentiment, and you've talked about sentiment a lot. So you're sort of balancing those two things, right? As you get into the latter half of November into December, it typically is, from a seasonal standpoint, you get that Santa Claus rally.
Yeah, that's right. You seasonally, so we're up against the seasonal tendency. I mean, you're in the strongest 3 months of the year, November, December, and January. Each of them have, at least a 63% historical probability of positive returns. I think December is like 73%. So it's, seasonality. You have to think about seasonality exactly like you would playing blackjack, right? If you play the system, you're gonna be right X number of times, and you can't say, I should have taken a card because the dealer, pulled a 5 and has a 21, right? I mean, it just is, right? Those things are going to happen. So again, from a probability standpoint, if you're going to play seasonality, this is the point where you want to be long, and there's usually that upward bias to it. But you have to think about that the same way every single year, which tends to work.
Right. Speaking of 52-week lows, Trump's approval rating, Pabs, 52-week low?
Well, but put that in context here. I mean, if you look where it was on election day, according to the Real Clear Politics average of polls, Trump was actually slightly ahead of where Barack Obama was, and about a whole point ahead where George W. Bush was at the same point in his presidency. So a few things to take away from that. One, Trump's not immune to political gravity. Two, the second term slump isn't unique to him. My guess is that had a lot to do with the election results that we saw on Tuesday, where, yes, it was an off-year environment, which typically the party that doesn't control the White House performs well. And I think Democrats, met or maybe even exceeded in some cases expectations. And you look at the through line, because you saw some relative moderates elected to the gubernatorial positions in New Jersey and Virginia. You obviously saw somebody on more of the progressive socialist end being elected the mayor there in New York. And what's the common thread? The common thread is voters are saying they have affordability concerns. One of the biggest differences between Trump in his first term versus the second term is on the economy. And when you look at the polls tell, or the voters are telling the pollsters, they measure the economy by the prices they pay. And if this sounds familiar, it should, because we're saying the same thing basically a year ago when we were talking about Joe Biden and the race at that time. So, when you look at his presidency, you look at what Kamala Harris, was running at the time, it was affordability. And so you get into the question of these voters. It's really the pocketbook politics. You have concern now amongst Republicans where Trump had made gains with younger voters, Latino voters, thought you owned them. Turns out you're only renting them because you saw them shifting back to Democrats because of these concerns on Tuesday.
But affordability, and Neil, I want you to chime in on this. Affordability, we're kind of stuck with, right? Because in order to get prices to come down and have things become more affordable, I have to have deflation. And that's not even a possibility. Right?
Well, it is. I don't think you want to deal with the employment backdrop that would be required to make deflation a possibility.
So the rest of the people that are working, it's going to be unaffordable. So we're going to be stuck at my chicken prices where they are and my egg prices where they are, right? This is the new level.
The price level tends to go higher over time. That's why we look at the rate of change. But the only way to deal with affordability is either declines in prices outright, or you basically see stronger wage growth, and you move up, in terms of real incomes, right? So that would help. Like I said, prices can come down. I don't think that you really want to deal with the employment scenario that would be required to get prices to actually come down that much.
But why don't we could just hand out money, and that should help affordability, right? I mean, if you give me $100,000, I can afford a lot more things.
Well, you know
It's
who's
so
talking about
simple.
handing out money? You know who's talking
It's so
about handing out
simple.
money? You know who's talking about handing out money? The president with the tax, with the
I
tariff.
know. I did hear that.
So that would probably undercut the idea around. Right now a lot of people have been hopeful because tariffs have been reducing, budget deficits, and that could be one thing anchoring the fixed income market. If we saw this week, right? I mean, there was some enthusiasm around the SCOTUS maybe reversing the tariffs, and what do we see? We see the rates market, yields going up and so forth. So, look, I mean, to Steve's point, you don't want to know what the labor market scenario would be to get prices down.
So we're either going to use the tariff money to pay consumers, or we're going to pay back the companies that we took the tariff money from.
I don't think so. I mean, that's probably more of a question for Steve, but I just think to me, it's foolish to think that the SCOTUS is the institution in DC that has the last say on this. If you think Trump's going to let them be the one to push the button, I think you need to see a psychiatrist. It's not like that. I just don't see that happening. And the fact is that, look, I mean, Congress, they are a very lazy bunch, okay? And they have delegated this responsibility to the president over a number of years. And there's a vast legal architecture from which the president can draw from to prosecute his trade war. So just because, I mean, it's Trump, right? So Trump went about this in the most extreme way possible with the IEPA tariffs. But there's definitely a way where he can temporarily put on tariffs of 15% baseline. I mean, for all we know, if he does a 15% baseline tariff, he could be collecting more, right? I mean, in terms of revenue, you just have a flat 15% baseline for several months, and then you buy yourself time to the national security tariffs. I mean, that's something that he can do using existing legal. I mean, Steve would know better than me, but using an existing legal architecture. So yeah, I mean, I just don't think that. I mean, again, my main point on this is if you think SCOTUS is the institution in DC that has the last say on tariffs, good luck.
I agree with what Neil said. I get a lot of questions. A common one I get is usually, well, why did Trump use IEPA if it was sort of on questionable legal authority? And you go back to President Trump came into office. He didn't have most of his team in place. So why not use what you think you have, even questionable durability, to just provide maximum flexibility and sort of shock the system? And I think that's why he chose to use IEPA. But as Neil points out, he has several authorities. Section 122 could provide up to 15%. As Neil said, for trade imbalances, you have Section 338 go up to 50% to address basically unreasonable trade. So Trump could take a fair amount of leeway with that. The important thing about both of those authorities is they can be imposed immediately, and they don't require any investigation. That provides you a bridge to either go to Section 232, which have been the sectoral tariffs, and or Section 301, which can be used for unfair trade practices. And if you're looking at the effective rate for China, about 47%, 37% of that is from the Section 301 tariffs that Trump imposed during his first term that Biden sort of modified during his term. So to Neil's point, tariffs will remain. I don't think that's really in question. I think that's why you're seeing trading partners, sort of respond accordingly. There is some question whether or not the administration is going to be required to refund about $90 billion that have been collected through the IEPA tariffs. So if you're one of these companies that was impacted by that, you may be looking to petition the government for some refund there. If that's sort of what the court rules to do, that's probably going to take some time. Depending on the refund, you might want to wonder, is that in your interest? I know probably for the quarterly numbers, it probably is, to sort of figure out what to do with a potential windfall. But do you want to sort of make a goodwill deposit with the administration? Say, look, no, it's okay, you can just keep it, and sort of, hope that maybe you can cash that goodwill deposit in at some later date. I don't know. That's something that, companies are going to have to wrestle with, I think, moving forward. And then You have to think about it from the Treasury perspective too. If the Treasury Department's going to have to issue $90 billion in refunds, they're going to have to make up that difference, I'm assuming, by issuing more Treasuries. And maybe that's where you're watching the yields on the bonds in anticipation of that is something to think about. So when are we going to get some clarity? It's probably going to be next month. Just we talked about lawmakers want to get home in time for Thanksgiving, justices want to get home in time for Christmas. I mentioned these deadlines. Believe it or not, they're real. So that's when I'd probably be expecting a decision there. But the devil will be in the details as to the refund process, if it even exists.
Let's move real quick back to employment just for a second in the absence of those payroll reports. So you had ADP out this week, Neil. Like what's the picture right now, and what's the Fed going to do?
Well, there's what they should do and what they may do. And there does appear to be a disconnect. Look, I mean, I'm just going to get on my soapbox. It's really fascinating to me to see how, folks that have been sort of the most sort of full employment zealots, I would call them, over the last number of years, very quickly kind of, seemingly pivot away from that, right? I mean, you look at, Jeff Schmidt, Austin Goolsbee, Beth Hammock, like all these people are hawkish. They are hawkish, and there does appear to be a split on the committee. And look, I mean, I think they're kind of slow walking into a labor market, problem here. You asked about, there's no jobs numbers coming out. That is true, but we do know, so alternative data, generally all week across the board this week, right? So, layoff announcements were up. The kind of ADP number, the Revelio number, those were bad. Contract below 50 on ISM, manufacturing and services employment. So there's nothing to suggest that labor markets are stabilizing. They're continuing to gradually cool. But what I find interesting is just how much people are willing to kind of rationalize away the slowing. Well, like you see this with layoff announcements. Well, there's been so many times where layoff announcements have gone up and it hasn't materially it hasn't been a big deal. I mean, you've seen a lot of that this week. I just find that sort of ridiculous. I mean, it's like, it's to me, it's like, I'm a very simple kind of person, right? Like it's a bad line and it's going up. That's not what you want to see. Right? Like it's just that simple, right? So it's about distribution of risk, right? This is a probabilities business. And if you're going to sit there and say, well, this layoff announcement data is volatile from month to month and it's not a perfect guide for unemployment. Okay, fine. But tell me why the unemployment rate's going down. Tell me why employment growth is likely to speed up. Tell me why we shouldn't worry about the fact that it's not, I mean, this is what's interesting about the layoffs now is that this is not DOGE related. This has to do with, this is across different industries. It's across, it's across the country. I mean, it's more widespread than it was 6 to 8 months ago. So I just think that, the labor markets are cooling. And I would just say the consensus never knows ex ante whether it's going to get worse in point of time, right? Like that to me is the issue. It's like, nobody ever can predict a nonlinear risk. What we know is that we're probably more susceptible to it than we had been maybe a few months ago. And I think that's what's important. And that's what the hawks, in my opinion, miss. This sort of myopic fixation with inflation, I think, look, I mean, the labor markets, if they continue to deteriorate as they have been, that'll take care of the inflation story over time. And if, again, like a lot of the core service areas like food away from home, Jeff mentioned restaurants being at 52-week lows. Talk to any of one of the reasons why that's happening is because they're telling you they're not raising prices. They're telling you they're allowing their margins to come under pressure in an environment where like sort of food at home has been a little bit more elevated, right? What does that tell you about underlying demand trends? So, I mean, I don't know. I mean, I think it's, the hawks to me are playing with fire. And I do worry about the labor market. I don't think we should rationalize away bad data. It's to me, it's about judgment and making a judgment call. And I think the risks to the unemployment rate are skewed to the upside. And to me, like there's a lot of enthusiasm about like a reacceleration in the economy and tax refunds and the tax law and what that means for GDP growth next year. I would just say if companies thought things were going to accelerate early next year, why are they announcing? I mean, why is the labor markets slowing down now, right? Like that's like, isn't that like a form of forward guidance? Like if you think, I mean, everyone knows these things have been passed. Everyone knows tax refunds will be better next year. Everyone knows that there are some certain parts of the OB3 law that kick in next year. If they all know that, and they expect demand to improve as a result of that, why is it that they're continuing to slow down their hiring and employment trends at the moment? Like it doesn't.
Well,
It
one of the
seems
great Yeah, one of the great tells that you have both for the economy and for the markets, right, is what's happening in credit. That's usually where you see the canary in the coal mine, right? Jeff, what are you seeing there as for either one of those things, both the economy and the markets? Anything?
Well, not really. I mean, there's a little bit of elevation. I know there's kind of this cottage industry that's developed around the big tech taking on debt and kind of this circular funding and financing and how that plays out. And look, I mean, I'm sympathetic to that because when you get to the end, it usually ends up being some type of credit event. But Mike Santoli talked about this last week, right? Which is kind of this transition that these big tech firms are going under, where they've been cash cows for a long time, and they didn't really have these big capex experiences because they didn't need them, right? And now just to keep up, they've got to change the composition of their balance sheets or the capitalization of the company to reflect that. Now, look, if you use other people's money to make money, that's a great way. It's called leverage, right? That's a great way to actually improve your returns, as long as your returns are higher than the cost of capital, right? And I think that's the big unknown here: is what does that look like? Is the cost of capital going to overwhelm the returns that are available? And that's a huge unknown. I think this is a transition. So we went from low debt to some debt with some of these companies, and I think people are probably letting their hair on fire a little bit around that because there is a transition. But I'm sympathetic to the idea that not everybody's going to win this AI race, and if you're going to take on a $500 billion or $1 trillion to try to win it and you don't, what does that do? Obviously, that's a problem. But we're seeing it in the CDS spreads of tech. The high yield kind of popped here in the last week. The trend of investment grade CDS, and CDS, by the way, for those who don't know, is essentially an insurance policy, right? You buy CDS as an insurance policy for a default out the next 5 years, and so the higher that number is, basically the higher the premium represents your probability of default. So as those move up, you're paying more for that insurance, which means the expectations are that the default rate's going up, right? So none of these are hair on fire. The trend has changed modestly, I would say, but certainly you are seeing that. Neil, I was going to ask you this because I'm curious with the data. Let's say, just for argument's sake, the government reopens and we get the first payroll number at the beginning of the year. What's the interim look like, right? We're going to be 3 or 4 payroll numbers behind. What do they do to make that up? Is that just a black hole, or do they, go ahead.
I don't know, because we've never really. We've missed the survey week, right? I mean, the survey week was in October, so they presumably weren't even collecting data during the time. So how is it that they're going to be able to produce a jobs number over the month of October? If the shutdown goes another 2 weeks, then we're talking about November being gone. November's done. So, I don't even know that at a minimum, we should see what happened in September, right? I mean, because that number was ready to go, already at the time of the shutdown, right? I mean, the shutdown started at the end of September, so we had all those numbers ready to go, so they could produce a September number. I mean, that would be helpful, I guess. But yeah, I don't know. I mean, we're kind of in uncharted territory.
Because if they're data dependent, particularly, and a big one, and I think probably, would you agree, the biggest disconnect between you and the Fed right now is the employment picture. You think it's substantially weaker than where they are. If they're going to fly in blind.
They are flying blind. I mean, this is like everyone says that they're too myopically focused on data. Now they don't have data, and now how are they? It's like one of the things that Waller says. It's like we hate data dependence so much. You can see what we're doing right now. I mean, I will say it does feel like, based on the commentary. I mean, Powell, he knew exactly what he was doing when he talked about like it's far from it being a foregone conclusion around December. Like introducing that language goes well beyond what he typically does in those press conferences. And he knew exactly what he was doing. And as we've been arguing, like I think between that and all the hawks that have been squawking since the meeting, they're ascendant. The hawks are ascendant on the FOMC at a time when my reading of the data should mean that they shouldn't be squawking as much, as loudly. So that to me is the tension right now. And it sounds like there's a bias to do nothing in the absence of data. Right? Like, so if let's say the data doesn't come out, it seems like there's a bias not to do anything. And I think that's problematic because whatever the Fed skips now, they're going to, I think, because of the outlook that we have, they're going to have to make up for it later. And the last thing I would say, it's not so much that my reading of the labor market is different from them right now. It's the forecast, the outlook, right? Like the things that that's where it's disconnected, right? And so what I would just say is that, you have ongoing slowing in the housing market. Resale inventories are, inventories are rising. There's probably room for construction employment to come down. Builders are sitting on a lot of unsold inventory. I suspect residential construction employment comes under pressure. We have ongoing problems in the goods side of the economy. That'll probably weigh on things like freight employment. And conditions in the service sector are weak. Like when restaurants and casual dining establishments are telling you that their margins are coming under pressure, what do you think that means for employment? It's sort of like, well, let's wait for it in the data. Like that's a recipe to look like an idiot in 6 to 12 months. And I just say, like, I think that the labor and let's also be clear, like it's not like anyone is telling you that labor market conditions are getting better, right? Like so. You never know when you go, as I said before, you never know when it's like gradual cooling to sharp, abrupt cooling. No one ever has predicted that. But if it's going to happen, I mean, the probability of a kind of nonlinear spike is substantially higher when things are getting worse. And that's kind of where I'm at. But I would just say, like, just go down the list. You can say you have housing construction, there's downside to housing construction employment. Freight, I've been pointing out rail car loadings as an example during the holidays, during this part of the year, rail car loadings are down. Trucking activity is down. So the good side of the economy doesn't look great. And then you look at key areas of service sector employment, like restaurants, margins are being squeezed. That's probably not good for leisure and hospitality employment, right? To me, it's like the outlook for employment is not good, and I think it's really foolish to just kind of say like, oh, it's all gradual, it's all still kind of happening at the same pace. Like, okay, fine, like, but if it started to shift abruptly, it's like, then you're going to start easing. Then you're going to start easing after it's already left the station. Well, thanks, that's really helpful.
Right. Well, that's why I'm curious if that's going to be just, they're going to have this data at the beginning of the year, and then is it just like we're going to have a lot of volatility in policy because they're catching up, right? Essentially.
I think we're already at that point.
Yeah, fair.
All right, let's move to the mailbag. I'll remind people, listeners to this podcast, that they can submit their questions to all of our social media platforms: X, TikTok, Instagram, LinkedIn, et cetera, et cetera. We'll be happy to take those in and send you a hat when we use your question on the podcast. So
we had some great.
With that, Harry, good morning.
We had some great videos that were. I'm talking here, damn it! Now we had some great videos, like and audio that were fantastic. They were better produced than this podcast, and then people had stopped. So please,
gun shy.
Bring them back. Yeah, right. They all look good. I mean, with the doctor, with his scrubs. I mean, all that was great. So, yeah, we're fans. Bring it back. Harry, floor is yours.
Thank you very much. So we have the question come from Phil Mike Williams. His question is the concept of a secular bull market or bear market dead? It's been over 15 years without a US recession, excluding the man-made recession in 2020. Recession seemed to coincide with the start of secular bear market. Appreciate your thoughts. That's it. Thank you.
So the real question, I think, here is, secular bull market is a bear or bull market. Is it dead? The notion of it, because the recessions are, I guess, few and far between. Right? Have we policed our way out of having recessions now? And does that mean that secular bull and bear markets are dead? I'm going to say no, but I'm going to let Neil handle the recession part of that call.
I mean, it seems whenever anyone asks, like, have we cured the business cycle? Oh man, that's a right. That sort of gets a little light bulb, sends off a light bulb, right? I mean, I've said this over and over again on the podcast. Like, I don't know. I mean, I think the economy is slowing. People are still citing GDP now running at 4%, even though that's not based on anything other than survey data. If you were to just do a simple GDP estimate based on the survey data, it wouldn't be anything close to 4%. So, people are taking some of these indicators as gospel, even though they're not even being updated at the moment. It's sort of amusing, but people are talking about a reacceleration, and as I mentioned, like. Why would companies be slowing things down now if they thought things were going to reaccelerate next year? There's sort of if you think about fiscal policy, like monetary policy, there's like fiscal forward guidance. The fact that it's not working may be telling. But I've always said that one of the ways recessions work is through an element of surprise, right? Like, so if companies and business and firms and households think things are going to be okay, and then they're not, that creates the kind of negative feedback loop that makes recessions more likely. And that's, I think, for me, the worry. It's sort of the opposite of where we were 2 years ago when everyone was expecting a recession and it didn't happen. And so that created this sort of upward momentum cycle where you had to kind of invest more, spend more on inventories, hire more. Today, you have kind of the opposite situation where implied probabilities of recession are actually quite low. I mean, both among the consensus economics community, but also obviously in the financial markets. And, that creates, I think, potential risk because, let's say the data do come out and it's like, oh, like things were a lot worse than we thought. And they're still getting worse. What does that mean? We thought they were going to get better by now. Hasn't happened. I mean, that can create its own kind of take on a life of its own, I guess.
Well, you hit a really important point there too, right? So Phil's asking about, is it important from the business cycle standpoint and the secular bull or bear market? Well, we had officially a bear market in 22, even though we didn't have a recession. And this gets to the point that, the reason that you and I work together, right, is because the economy and the market are different things. They hold hands, but they are, they're not in a tight embrace, right? And so you got to be very careful about, trying to predict one versus the other because you can be off. And, you had a great call in 22, which was we're not going to have a recession. And that was right, but we still had a bear market, right? And so, Phil, if you're using the economy to make your bullish or bearish call, just be careful with that because they are separate. I wouldn't call them independent, but their correlations can definitely be lower than I think the presumption is that's on the street. But thanks for the question.
Thank you indeed, Phil. We'll get you a RenMac trucker hat for sure. And for the listeners out there, remember, go to renmac.com for information about how to become a client, get our newsletter. If you're an institution, we'd love to have you on board to see what else we do beyond this pod, the deep dive stuff that we do here.
Are we not going to talk about the mayoral election?
We were going to get into the what to look for this week and then hammer about the situation in New York. Steve Pavlik, What do you got this week for us?
Well, I guess we'll talk about the shutdown. You mentioned the 52-week low for Trump. We talked about the election results. We talked about skepticism amongst the Supreme Court of his signature tariff policy, and now there's growing frustration that the government shutdown persists. And one of the byproducts of the election result is that Democrats appear to be digging in, and that's why we're looking at probably a longer one. So we're recording this Friday morning. I have to put the timestamp on it. The Senate's supposed to vote this afternoon, and my guess is probably going to get delayed possibly into the weekend if Democrats try to filibuster this thing out on a new stopgap that would go beyond the November 21st date, time TBD, as of this recording, to either December or January. My guess it'll probably be in January. And I'm not sure that moderate Democrats that have been working on this deal are going to support it. It also includes an agreement to include some other spending bills, as well as a commitment to vote at some point on an ACA subsidy bill. And I think Republicans' leadership has been pretty clear that they can guarantee a vote, they can't guarantee an outcome. And President Trump is yet to weigh in. And my guess is if he decides to, that will have a lot of sway, particularly with the House. But at this point, I'm not anticipating anything to really happen over the weekend. So maybe we're looking at next week to potentially get some resolution there in the Senate. And then you're probably going to have to look to the following week to probably get the House back, see if they'll go ahead and ratify it, which probably leads us up to what we were talking about at the beginning of the podcast, trying to find some resolution here before lawmakers want to go home for Thanksgiving. So look at the week of the 17th. That's probably the most optimistic case. I think that's probably where things are in Kalshi, the online betting market. So that's what I'm watching for this week.
Did anybody see the Babylon Bee post yesterday?
No.
Mamdani moves mayor's office under Children's Hospital.
I saw one that said Florida Realtor of the Year with his picture on it, but that was
I'll tell you what, I made a sign. I made a sign for my front yard that says "Not for sale, but willing to listen."
Well,
Yeah.
as with none of us living in the city, we got a lot of thoughts. Neil, what do you think? Not about what you're looking for, but
I
just
don't
go to
want
the
to.
mail.
I don't want to. I don't want to
Touch
step
it.
into something. Yeah, I just don't want to step on any of that. Yeah, look. I mean, I think. I was in terms of election views. I mean, I wasn't surprised. I mean, I guess I was a little, to the extent I was surprised about any of the results yet this week. It was the fact that the Jersey governor's race wasn't as close as as
Yeah,
expected.
but the poly markets had all of them right. I mean, I don't think in New Jersey
Yeah,
it
no,
dipped
I mean that
anywhere below
to me is not.
85%.
Yeah, like I never thought that. I mean, right? It was just about margins, right? I mean, to me, it was surprising how wide the margin was between Sherrill and Citarelli. Look, I mean, that to me was the only surprise. I mean, is anyone surprised by Mamdani? I mean, I do think I do have this this interesting view about this notion of like I'm a democratic socialist. Like I don't actually think it is what he says it is. You know what I mean? Like to me, that's more of a cultural identifier more than an economic philosophy. Like when they talk about it, right? Like you see what Mamdani's doing. Like he did a whole thing. He did a whole video like on like one of his like planks of his platform is like I'm going to try to make licensing easier for like the chicken and rice guys. Like that's not socialist, right? Like you're trying to cut red tape for like the people that run food carts in New York City, right? Is that right? Because that's like a huge thing, right? There's a lot of red tape. There's a lot of like you have to put a lot of money up. Like only a few people get the licenses, right? There's a lot of like sort of old city regulatory burden on with respect to that. Like, is that democratic socialism? So, my view is like a lot of times, like people say these things. It's more of a cultural identifier than anything else. Is he actually talking about like? I mean, first of all, a lot of what he plans to do, it's going to be difficult for him to do it because the governor is not on board with what he's talking about. And could you imagine if like Elise Stefanik actually wins in New York next year? Forget it. You know what I mean? Like that'll be fun. It'll be more fun than Cuomo versus de Blasio. But look, that was like my only interesting kind of take is that, people throw these terms around like I'm a democratic socialist. But I think that's more of a cultural identifier than anything else. Like when we talk about socialism, it means government ownership over the means of production. Like, is that what really talking about? Like, no, they're not talking about that.
And he
So
can't tax without Albany, right? Like the whole idea of a
100%,
billionaire's
like,
tax.
yes. Like,
But the two things that I would just add, Neil said, one was the margin. And I think that was where you saw the upside for the more moderate candidates. Spanberger in Virginia, Sherrill in New Jersey, their vote totals actually exceeded what the polls had, whereas Mamdani was actually lower than what they thought his margin of victory would be. And so the question is, a lot of what he's promised to do, I don't know, as we've sort of been pointing out with respect to the limits of the governor and the local Congress there in Albany, is he actually empowered to deliver on these things? So that's going to be the question moving forward is, you promise these things, can he not deliver on them? Or in some cases, if he can, is it well received? And I think, Republicans will be looking to try to elevate his status as maybe the new foil now that Pelosi's gone ahead of the midterm. So that's sort of how to think about it moving forward.
Well, the other thing too to keep in mind, right? I mean, it might be just a brilliant strategy, which is promise the moon, know that you can't really get it done, right? And just then blame the other side and just say, oh, this utopia that I was going to create, these bastards are standing in the way, right? And but if we do it one more year, we'll be able to go again.
It sort of reminds me of like fifth grade when the kid's running for like class president, promising like no school on Fridays and free pizza. Then he gets in there and it's like, oh, well, if it wasn't for the principal, I could do this stuff. So you might be onto something.
That was my plank, by the way. Didn't work. Jeff, what do you like?
It was your background that didn't work. That's didn't take long to uncover.
I was in fifth grade.
Exactly.
For everybody.
Right. That's how bad it was, or is.
What do you got for us, Jeff? What are you focused on this week?
Look, our market cycle clock came out earlier this week. It was in the same zone, but moving in the right direction. So we want to continue to see that inflation portion of the cycle clock move lower. So that will be key. Discretionary has definitely weakened, and that's been an important theme for us over the last couple months now. We wanted to see that firm and stay decent. The one part of that, which is a little bit of a relief, though it's not a victory by any means, is that they still discretionary is still acting better than staples, right? So that's certainly something that you want to see to have a more bullish bias. But look, I'm looking for tops. I'm looking for breaks. There's a lot of vulnerable charts that we have that we've been publishing for clients and looking at it. This is actually a pretty fun market from my perspective because you can play both sides. And that's I'm just looking for deterioration in some of the leaders that would be more problematic. I mean. The other part, I guess, is just to watch some of these parabolic moves, right? You've got Korea, which has started to soften a little bit, and that's been part of the focus, the international focus of the chip and the AI trade. So you are seeing some fissures there. We're not oversold yet in some of the high octane beta names, particularly in the Russell 2000, like the quantum names. Some of the rare earths, a lot of these things have come back down to earth, but haven't hit yet. They're at least back down into the lower atmosphere, I would say. But they're not oversold. And so a big part of, our strategy as we'll go into 2026 is hopefully we get oversold conditions in some of these high flyers. That creates some type of interim floor, and then we can rally from there. If we can't rally from that interim floor, then we've got a bigger issue for the market generally. But right now, I would consider this a pause or a correction, particularly in those names within that ongoing trend.
And Jeff, real quickly before we wrap, crypto weakness. Do I care? Do I not care?
Yeah, I care. And it's the sketchy. Sketchier you are, with the exception of Zcash, which I don't know what's going on with Zcash, but our friend Neil Dutta seems to have it on his phone every 30 seconds as I get texts.
That's why he's on vacation.
Yeah, exactly. Look at Doge. Look at what I call. I won't say it. Sketch coins, right? So some of these things that are just pure like equities were back in the 1870s, right? You just you just dilute your way through, hardly any regulation, et cetera. But Ether looks weaker, and just kind of on down the spectrum, if you will. Bitcoin still is in an uptrend, but it really needs to hold 95,000 to stay, just from a pure technical kind of low high basis, stay in that trend. So that looks a little bit more vulnerable to me than it has in a long time. So I thought it was going to break out and go to 135, but that proved to be a false breakout. And now I think we have to be a little bit more cautious and defensive there. I am short MicroStrategy as a hedge to the Bitcoin long, so that there's another bad chart that's out there that certainly is the way that I'm playing it.
All right, well, let's wrap it there before we get into trouble. I see Neil.
Well, wait. Where's Neil? Because Neil looks like I want to see what country Neil's going to dunk on this week.
I'm in Portugal, but for a couple of days. Yeah, I'll be. There's nothing really going on in economics next week. We were supposed to get a CPI.
That's why I didn't ask you.
We were supposed to get a CPI number. That's not coming out. I think we were also supposed to get a retail sales number. That's not coming out. But, we'll be keeping an eye on, I guess, state-by-state jobless claims. I mean, you kind of have to go down to the bottom of the barrel to make sense for what's happening. So, it is what it is. Other than that, we'll be on the subreddits looking for the next crypto meme.
You can write an app for that. Go to Replit. You can write an app to find that for you.
Well, let's leave it there. Thanks everybody for listening in on this podcast or on the YouTube. Go to the like button, go to the follow button that you can see below. And we'll be back next week. We'll be 1 week older and 1 week wiser. Until then, I'm Steve Duttenhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
Thanks everybody. Have a great week.